Hello and welcome to Explain the Charts. Today, November 23rd, 2025, we are taking a deep dive into the EURUSD currency pair, which is sitting at a critical inflection point. First, we'll cover the latest news driving the market, and then we will break down what the charts are telling us across multiple timeframes. The big story right now is the significant and growing divergence in monetary policy between the US Federal Reserve and the European Central Bank. Recent minutes from the Fed have been decidedly hawkish, reinforcing their commitment to maintaining a strong stance against inflation. This has been a powerful catalyst for US dollar strength across the board. In stark contrast, the ECB is widely expected to keep its interest rates on hold well into 2026, creating a fundamental headwind for the euro. As a result of this dynamic, major institutions like UBS have been revising their EURUSD forecasts downwards. The prevailing sentiment among analysts is bearish, with many viewing any short-term rallies as prime selling opportunities. Now, let's see how this narrative is reflected in the price action on our daily chart. Looking at the bigger picture going back to mid-2024, we can see the pair peaked near the 1.19 level back in September of this year. Since that peak, EURUSD has been in a clear and sustained downtrend, carving out a channel of consistent lower highs and lower lows. This price action is a textbook reflection of the strengthening dollar story we've been hearing in the news. The selling pressure has notably accelerated over the past month, pushing the pair down to a critical juncture. We are currently testing the major psychological support level at 1.1500. This level is not just a round number, it has historically served as a significant pivot point, acting as both support and resistance. A decisive daily close below 1.1500 would be a very bearish signal, likely opening the door for a much deeper decline. Looking below, the next major area of support comes into view around the 1.1400 handle, a level that some analysts have flagged as a potential target. If that level fails to hold, we could be looking at levels not seen since the middle of this year, possibly targeting the 1.1250 area. On the upside, any bounce from here will face a wall of resistance. The first minor hurdle for bulls is the recent breakdown point around 1.1542. Beyond that, the 1.1600 area will present a more formidable barrier. However, the key resistance zone that would truly challenge this entire bearish trend sits much higher, between 1.1670 and 1.1690. To get a clearer perspective on this recent move, let's zoom in on the daily chart from the September high onwards. As you can see, the downward momentum is undeniable, and the slope of this trend has steepened considerably here in November. Pay close attention to the large, bearish candles from November 19th and November 21st. These candles demonstrate strong conviction from sellers and closed near their lows, which indicates that sellers were in complete control. There has been very little buying pressure to absorb this selling, suggesting the path of least resistance remains to the downside. This recent price action is a classic example of a trend gathering momentum, and it directly correlates with the hawkish Fed news that has been dominating headlines. Now, let's switch to the 1-hour chart to analyze the short-term structure of this decline. Here we can see the anatomy of the recent sell-off in greater detail. It's a classic staircase pattern downwards, where the price falls, consolidates sideways for a bit, and then continues its descent. Notice how previous support levels are flipping to become new resistance on any minor bounce attempts. For example, after the price broke below 1.1550, it tried to rally, but was quickly rejected from that same level before continuing lower. This confirms the analyst sentiment that rallies are being faded aggressively by market participants. The hourly structure currently shows no signs of a bottom forming, as each attempt by buyers has been swiftly negated. Drilling down even further to the 15-minute time frame for the last couple of days gives us a microscopic view of the action. We can observe the tight, sideways consolidation that occurred right before the most recent leg down on Friday. This coiling of price action before a sharp breakout lower is often a sign of building bearish pressure. The inability of bulls to generate any meaningful upward momentum during that consolidation period was a major red flag. When the support at 1.1520 finally gave way, the move lower was swift and decisive. The pair is currently sitting near its weekly lows, which points to potential weakness heading into the new trading week. There is simply no evidence of short-term buying strength at this very moment. Let's pull back to the daily chart, focusing on the last 3 months to recap and discuss what might happen next. To summarize, the key levels we are watching are critical support at 1.1500. Below that, our downside targets are 1.1400 and then potentially 1.1250. To the upside, immediate resistance lies at 1.1542, with more significant resistance at 1.1600 and the major trend-defining zone at 1.1670 to 1.1690. Now for the potential scenarios. The bearish case currently holds the highest probability, which I would place around 75%. The fundamental and technical pictures are in perfect alignment for further downside. A daily close below 1.1500 would be the likely trigger for a move towards the 1.1400 target. This bearish view would be reinforced by any more hawkish Fed commentary or weak economic data out of the Eurozone. On the other hand, the bullish case appears to be a lower probability, around 25%. This would require a very strong defense of the 1.1500 support level. We would need to see a powerful bullish reversal pattern form on this daily chart, followed by a swift reclaim of 1.1542 to show initial strength. For the entire downtrend to truly be questioned, bulls would need to push price all the way back above the 1.1690 resistance zone. This seems unlikely without a major fundamental catalyst, such as a surprise dovish shift from the Federal Reserve. So, the primary thing to watch in the coming days is the price action around the 1.1500 level. Whether it breaks or bounces from here will likely set the tone for the remainder of the year. Keep a close eye on upcoming inflation reports and any scheduled speeches from central bank officials. Of course, please remember that this analysis is purely for educational purposes and should not be considered financial advice. Trading involves significant risk, and it is crucial to conduct your own thorough research before making any investment decisions. Markets can be highly unpredictable, so always be sure to manage your risk effectively.